My name is Michelle Singson, and I'm the Manager of Tax Operations at EWM Tax Solutions. Today, I'd like to talk about the concept of tax loss harvesting. Even in the best of times, not all of your investments will be winners. However, even in bad times, a losing investment can be turned into a smart tax-saving strategy. Tax loss harvesting is the selling of securities at a loss in order to reduce a capital gains tax liability or ordinary income tax burden, effectively lowering the amount you may owe in income taxes. Often, this is used to offset short-term capital gains, since they are generally taxed at higher federal rate than long-term capital gains. Basically, it works like this. An investment that has an unrealized loss is sold, which allows for a credit against a realized gain. For example, if you believe you may have a $5,000 capital gain to report on your tax return, you might sell other investments that may generate a loss of $5,000. This results in a lower capital gain and therefore a lower tax burden. In any year, a taxpayer can offset capital gains with a capital loss in up to $3,000 in income. A situation in which this may work is if you believe that your tax bracket in retirement will be lower than it is while you are working. In this case, it may make sense to defer capital gains until that time. Your tax rate now and your tax rate in the future should be carefully considered. One thing to note is that tax loss harvesting only works with investments held in taxable accounts. Tax-deferred accounts, such as an IRA or 401k, do not allow offsetting of capital gains. Even if you don't have a capital gain to offset, you can still take advantage of this. You can use your losses to offset other income and therefore lower your taxes. Any net loss over the $3,000 limit can be carried forward to offset other income or capital gains in the future. To explain what tax loss harvesting is, let's look at a simple example. At the beginning of the year, this taxpayer bought $100,000 of stock in her taxable account. And let's imagine that as of today, it's worth approximately $93,000. To take advantage of tax loss harvesting, she would sell that fund, thereby recognizing a $7,000 capital loss. She can use the $7,000 capital loss to offset any capital gains she realized this year. And if her capital losses exceed her capital gains for the year, she can use up to $3,000 of her net capital loss to offset ordinary income. Although this could be a great strategy, you shouldn't make an investment decision based entirely on taxes alone. You'll have to decide if deferring your capital gains to a later time is beneficial or not. If you have questions or would like to discuss if the strategy would be right for you, please give us a call. Our team at EWM Tax Solutions would love to help you earn more, keep more, and live more. Thank you for watching. We look forward to hearing from you.